So right now, businesses across the world are just staring at their screens, celebrating these high click-through rates on their Google
Oh yeah,
ads.
they see those little green arrows pointing up.
Right, they see the traffic spiking, the arrows are up, and they honestly feel like absolute marketing geniuses.
Sure, it feels great in the moment.
But what they don't realize, and this is the scary part, is that those very same clicks might be quietly bankrupting them.
Exactly. It's a very dangerous illusion.
Yeah. So if you are running campaigns and you still have this cold sinking pit in your stomach because your bank account just isn't reflecting what the dashboard says, well, you are in the right place.
Because today we are dismantling that illusion entirely.
Okay, let's unpack this. We have an incredibly detailed guide to work from today for this deep dive. It's created by a specialist operating out of BTW Media.
Right, and BTW Media is a marketing consultancy agency based in South Africa.
Exactly. So the specialist wrote this guide specifically for South African SMEs, small and medium-sized enterprises. But as we go through this material, it becomes immediately clear that the mechanics are universal.
Oh, completely. Whether you're running a plumbing business in Cape Town
Yeah.
or, I don't know, an e-commerce store in Chicago.
Yeah, the underlying mechanics of how we waste money on advertising, they just don't change.
The geography changes, right? But the psychological trap of the software remains exactly the same.
So what is that trap exactly?
Well, the source points out a fundamental flaw in how most businesses approach this. They treat their advertising budget like it's a speculative cost center.
Like a slot machine.
Yes, exactly. They throw money into the machine, they look at the dial spinning, and they just cross their fingers hoping revenue comes out the other end.
And the reason we do this is because the software itself is literally designed to give us a false sense of security.
It's built that way, yeah.
The guide talks extensively about this trap of vanity metrics. And look, I know you, the listener, likely already know what a click or an impression is.
Right. If you're running ads, you know the basics.
But let's talk about why we still fall for them anyway. I mean, when I log in, Google puts those numbers front and center. I see I got 1,000 clicks, and it just feels like a win.
Well, let's look at the mechanism behind the dashboard there. The platform defaults to highlighting clicks and impressions because, well, that is what they're selling you.
Right.
It's their revenue model. An impression simply means your ad loaded on a screen. That's it.
The user might have just scrolled past it in a fraction of a second.
Exactly.
Yeah.
And a click just means someone was intrigued enough to visit your website. But if we tie this back to the real world, the guide uses this brilliant analogy.
Oh, the restaurant one. I love this.
Yeah, it says, celebrating a high click-through rate is like throwing a massive party at your restaurant, seeing a line out the door, watching people fill every single table, and then high-fiving your staff.
Right, but you never actually check if anyone ordered food.
Or paid their bill before they left.
You're literally just paying for everyone's dinner.
Exactly. It is a brutal image, but it makes so much sense when you think about it.
Because every single one of those clicks has a very real RAND value attached to it.
And this brings us to the core pivot that the BTW Media Specialist insists we have to make. We must shift our attention away from the vanity metrics.
We have to force the system to optimize for value metrics,
Yes.
right?
Things like cost per conversion, conversion value, return on ad spend, and true return on investment.
Okay, let's pause and talk about the difference between return on ad spend, ROAS, and ROI. Because I've seen business owners brag about their ROAS online, and they are completely ignoring the larger financial picture.
Oh, it is a very common blind spot.
Oh, yeah.
So let's break down why. ROAS simply measures the efficiency of your advertising in a vacuum.
The math is just revenue from the ads divided by the cost of the ads, right?
That's it. So if you spend, say, R5,000 on Google Ads, and those ads directly result in R15,000 of sales, your ROAS is 3 to 1.
So for every rand you put in the slot machine, 3 rands came out.
Right.
Which sounds amazing. I mean, if I have a machine that prints 3 rands for every one I give it, I'm going to empty my savings account into that machine today.
You would think so, yeah. But actually, that's exactly where the danger lies. ROAS does not care about your overhead.
Oh, right.
Let's say you run a custom furniture business. Yes, the ad generated R15,000 in sales. But what did the wood actually cost?
What did you pay your carpenters?
Yeah, exactly. What was the cost of the petrol for the delivery backy? If your margins are incredibly tight, you might find that after all those expenses, you actually lost money fulfilling those orders.
Wow. So the ad worked perfectly, but the business took a loss.
Precisely. And this is why the source is adamant that ROI, return on investment, is the golden metric.
Because ROI calculates the true business profitability.
Yes. By factoring in the cost of the goods and the ads against the revenue. It asks the ultimate question, after I paid Google and after I paid for my materials, did I actually increase the net wealth of my business?
And the specialist recommends running both of these calculations every single month.
Every month, yeah. So you never confuse a successful marketing campaign with a profitable business venture.
Okay, so if vanity metrics are just window shoppers and we need to transition to value metrics to survive, we face a technical problem here.
We do.
How do we actually bridge that gap? Because a phone call or a store visit isn't automatically tracked as cash in the bank by Google.
Well, you've hit on the absolute bedrock of a profitable campaign. To transition to those value metrics, you have to feed the algorithm the right data.
Because you cannot calculate what you do not measure.
Exactly. And this requires setting up precise conversion tracking.
The source notes that setting up conversion tracking fundamentally transforms your dashboard. It stops being a report on clicks, and it becomes a report on customers.
It changes the whole game.
But I want to push back on the definition of a customer here for a second.
Okay, go ahead.
Because if I run an e-commerce store, a conversion is obvious, right? Somebody put an item in the cart and swipe their credit card.
Very straightforward.
But what if I'm a local SME? What if I run a hardware store in Johannesburg? I don't sell hammers on the internet.
This raises such an important question about how we define intent. For a local SME, a conversion isn't necessarily a digital transaction.
Oh, wait, what is it then?
It is any valuable action that serves as a leading indicator of revenue.
Leading indicator.
Right. For your hardware store, maybe you have a form on your website to request a quote for bulk materials. That form submission is a conversion.
Okay, that makes sense.
Or let's say someone searches for a hardware store near me on their phone, they see your ad, and they click the button to call your shop directly. That phone call is a conversion.
The guide also mentions tracking direction requests, which initially kind of threw me.
Oh, really?
Well, if someone just taps a button to ask Google Maps how to drive to my shop, we count that as a conversion. I mean, they haven't bought anything yet.
Think about the psychology of the user in that exact moment, though. If someone is taking the time to map the physical driving route to your specific storefront, they are demonstrating incredibly high intent.
I guess that's true.
They are literally figuring out how to navigate their vehicle to your cash register.
Oh, wow. Yeah, when you put it like that.
For brick and mortar business, foot traffic is the lifeblood. By tracking that direction request as a conversion, you are sending a vital signal back to Google's machine learning algorithm.
Ah, so it's not just about me looking at the data, it's about training the system.
Yes. And that is a massive paradigm shift. When you don't track these actions, Google just optimizes your ads to find people who like to click on things.
Which we already established is bad.
Right. But when you do track them, you are explicitly telling the algorithm, hey, find me more people who look and behave exactly like this person who just asked for driving directions.
Okay, so I'm sold on the philosophy. I need to train the algorithm and track these conversions.
Excellent.
But here's where we hit the wall that stops so many business owners in their tracks. The actual software setup.
It can be intimidating.
It's terrifying. But the specialist from BTW Media refuses to let us off the hook. They provide a step-by-step logic for setting this up, and it's less about pressing buttons and more about, defining your boundaries.
It really is a logical progression. The first phase is simply telling the system where the finish line is.
Right, step 1 and 2.
Yeah, you go into your settings and define the source of the conversion. Is this action happening on your website, like a, quote, form, or is it happening via the ad itself, like those direct phone calls we just discussed?
Okay, and then once we define where it happens, we have to define what kind of action it is.
Step 3, exactly.
Is it a purchase or is it a lead? And the guide highlights a very specific setting here called the count setting, which seems minor, but could completely ruin your data if you get it wrong.
Oh, the count setting is crucial because it determines how Google records repeat actions from the exact same person.
Explain that.
Well, let's say you run that e-commerce store. If a customer buys a pair of shoes on Monday and then comes back and buys a jacket on Wednesday, you want to count every conversion.
Right. I want credit for both of those sales. They are separate transactions.
Exactly. Those are two distinct profitable transactions. But if you are generating leads for a service business like a roofing contractor, the logic completely flips.
Okay, how so?
Imagine a homeowner named Steve. Steve fills out your online quote form. Then, 2 hours later, Steve gets impatient, goes back to the website, and submits the exact same quote form again just to make sure you got it.
Oh, no.
If your setting is to count every action, Google's dashboard will proudly tell you that you just acquired 2 brand new customers.
And I didn't. I just have one very annoyed Steve.
Yes. And suddenly your ROI calculations are completely detached from reality.
That's a nightmare.
This is why for lead generation, you must set the count to 1. It protects the integrity of your data.
That makes total sense. Now let's talk about the phase of the setup that causes actual panic.
The installation.
The installation. The guide talks about installing a tag or a code snippet on your website. I have to be honest, whenever I hear the phrase, add a code snippet to your site's header, my brain just shuts down.
Most people's do.
I immediately assume I'm going to accidentally delete my entire website. Do I need to hire an expensive developer for this?
This fear is so universal that the industry actually had to build a workaround for it. The source heavily recommends utilizing Google Tag Manager to handle this.
Google Tag Manager.
Okay.
Think of Google Tag Manager as a diplomatic solution between marketers and website developers. It is a completely free tool, and it acts as a secure middleman.
How does it work?
Imagine your website is a physical office building. Trying to manually paste code snippets into your website's header is like knocking down drywall every time you want to install a new security camera.
Oh man, that sounds risky and messy. It is. Tag Manager is like installing a universal mounting rail on the ceiling just once.
Okay.
From then on, whenever you want to add a new tracking tag, whether it's for Google, Facebook, whatever, you just snap it onto the rail using a simple, user-friendly dashboard.
So you never have to touch the actual structural code of the website ever again.
Exactly. Never again.
That is a massive relief. It completely removes the technical bottleneck, but the specialist stresses that you aren't done once it's installed. You have to verify it.
Verification is non-negotiable. The guide suggests using Google's Tag Assistant to ensure the tag fires, but beyond that, it recommends a practical test.
Like doing it yourself.
Yes. Go to your own website, pretend to be a customer, fill out the contact form yourself, then wait 24 to 48 hours and check your Google Ads account to ensure that specific test registered.
And if you skip this step,
If you skip this and the tag isn't working, you are still flying blind, but now you have a dangerous false sense of security.
okay, let's fast forward. We've conquered the software, the tracking is verified, the data is flowing in cleanly. The fun part.
Yes. Now we reach the most critical part of this entire deep dive. Calculating our true ROI using the practical worksheet provided by the BTW Media specialist.
Because raw data is useless until you translate it into financial reality.
Right. So the first step is simply gathering the raw numbers.
Yeah, you isolate a specific time period, let's say the last 30 days. You pull the total cost of your Google Ads, and you pull the total number of conversions that the system accurately tracked.
For example, maybe you spent R5,000 and the dashboard shows you received 15, quote, form submissions.
Perfect.
But here is where I see a massive mental roadblock for business owners. The next step in the worksheet requires us to assign a RAND value to those conversions.
Yes, step 2.
Now, if I'm an e-commerce store, the cart value is automatically tracked. Easy. But if I'm a service-based SME, let's use a plumber in Pretoria as an example.
Okay, the Pretoria plumber.
I get a form submission. I have no idea what that job is worth until I drive to the house and actually look at the pipes.
Right, it varies wildly. It could be a simple R500 leak, or it could be a massive R10,000 geyser replacement. How can I possibly assign a fixed value to a lead when my business is that unpredictable?
It feels impossible when you look at it on a case-by-case basis. But the framework the source provides relies on the law of averages.
The law of averages.
Yeah, you aren't trying to predict the future of one specific pipe. You are measuring the historical aggregate of your entire business.
Okay, walk me through the math of that.
Let's stick with your plumbing example.
Yeah.
You look at your historical data over the last year. You know that, on average, for every 5 leads you get from your website, you manage to close the deal on 1 of them.
Okay, so your conversion rate from lead to paying customer is 20%.
Exactly. Then you calculate the average value of all your jobs combined over that year. Let's say it averages out to R2,000 per job.
So 1 in 5 closes, and an average job is R2,000.
Right. Now we distribute that value. To find the mathematical value of a single lead, you take that R2,000 average job value and divide it by the 5 leads it took to get it.
Okay, let me think. So 2,000 divided by 5 is R400.
That's your number. This means, statistically speaking, every time a new lead drops into your inbox, it is worth R400 to your business, regardless of what the actual plumbing issue turns out to be.
That is brilliant because it entirely removes the emotion and the day-to-day guesswork. It creates a stable, reliable baseline for our marketing math.
It really does. And once you have that baseline, you plug it into the third step of the worksheet, running the ROI calculation.
Okay, so going back to our raw data, we had 15 tracked form submissions last month.
Right, and we multiply those 15 leads by our established R400 value. That means our ads generated a total conversion value of R6,000.
We spent our 5,000 on the ads, and they generated our 6,000 in value.
Yes, so we use the ROI formula. Total value minus total cost divided by total cost multiplied by 100.
So our 6,000 minus our 5,000 leaves us with our 1,000 in profit from the ads.
We divide that R1,000 by the initial R5,000 cost, which gives us 0.2. Multiply by 100 and you have a 20% ROI.
Wow. Your marketing generated a 20% return on top of your initial investment. And this brings us to the final step of the worksheet, analyzing and interpreting that percentage. Because a number is just a number until it dictates an action.